Good morning, folks. My name is Dave Beattie. I'm the Legislative Compliance Manager at HR Talk Outsourcing. I will be doing today's presentation. It's called 2023 Legislation Refresher Webinar 1, because the plan is to do a couple more this year. And it's just going to cover a couple of issues that our clients generally have a problem with. In terms of my background, I worked at SARS for 6 years, and I've been at HR Talk for just over 22 years, and quite familiar with payroll processes and the payroll environment. I also do a lot of the training in the payroll space. So that's why I've identified these issues. Okay, so the issues that we're going to look at today, we're going to start off with long service awards. A couple of recent legislative changes there, which we're going to look at. Then we're going to look at no or low interest loans. Quite a few recent changes there in terms of the rates because of our volatile repo rate. We're just going to look at that. We're then going to move on to retrenchments and mutual terminations. Very, very topical issue because it's an issue that's dealt with very badly. And because of our economic situation, we've seen in the payroll environment a lot of retrenchments and mutual terminations. So we're going to just go over the HR and the tax implications of that very quickly. We're then going to move on to bursaries and then learnerships. Still some challenges in the learnership space. We're then going to look at the concept of internship, and then home offices, and then lastly, employee transfers. Okay, so the long service awards, legislation has finally been re-looked at by SARS, and you would notice that there has been a legislative change in the last year. We'll go over to that RP5 code and the treatment thereof. But as a starting point, I'd prefer to look at what is long service and what is qualifying long service. I've had a lot of queries recently, a lot of companies looking to become employers of choice, recognize their employees, and have some sort of a long service program. And it would make sense if you're going to do that to tie it into the tax implications of long service. And those implications are SARS provide an exemption, provided there's 15 years of unbroken service. We call that the initial qualifying period. And then you'll have subsequent qualifying periods, and those are every 10 years of unbroken service after that year 15. Now, should you choose to only reward someone at year 20, the same exemption would apply, but your subsequent qualifying period would become 30 years and then 40 years. So you can't go 20 and 25. You would only be able to go 20 or 30 and then 30, or 15 and then 25. As I mentioned, there has been a legislative change as of 1 March 2022. And that exemption, the 5,000 exemption, now also is applicable to cash payments. Previously, we used to do a little dance around SARS in that the exemption only applied to actual assets, and cash was fully taxable. So there was always a few tricks as to how you get by the cash issue. The use of gift vouchers has always been an acceptable method of rewarding long service, as it represents the right to acquire an asset. So a gift voucher to your local shopping center, you can go and redeem that voucher for assets. So that was always no problem. Kruger Rands are also regarded as assets, and the 5,000 exemption would apply to them. Now, the new thing is the IP5 code 3835. And should you reward an employee with a long service payment, you would be required to use code 3835. So the long service award tax calculation your first step is ensuring that you meet the requirements of long service. So in other words, the 15 years and then the 10 subsequent years. The second step is valuing the award. So whether that be cash, or cash would obviously be obvious, but buying an asset, it would be the market value, the arm's length transaction value of that asset. And then the third step is value the award so that you can reduce it by the lower of its value or the 5,000 Rand exemption. As I mentioned, the long service payment has to go into code 3835. SARS will then reduce the taxable value in that code by the 5,000 Rand exemption, meaning that only the balance of the amount in that code would be taxable. Should the long service award take the form of an acquisition of an asset at less than its actual value, or the right of use of a company asset, then you cannot use codes 3801 or 3806, because these acquisitions or right of use are actually relating to long service. So the value in that case. So if you allowed an employee to acquire an asset of value 10,000 because of qualifying long service, you would have to put that 10,000 into code 3835, and then obviously SARS would apply the 5,000 exemption. In any other case, you would use the general fringe benefits or the 3806 for those codes. But in summary, if it relates to a long service award, it has to go to code 3835. Unfortunately, SARS has chosen not to increase the 5,000 exemption, which I think is quite pitiful. But I know that these things are on the radar of SARS. All values that have been in legislation for a long time will be looked at. Low or no interest loans. So the SARS official rate of interest is defined in section 1(1) of the Income Tax Act, where a loan is obtained by an employee from their employer as a result of the employment relationship, where no interest is payable, or the interest is less than this official rate of interest, there will be a fringe benefit. The Rand value of the fringe benefit is then obviously taxed monthly. Now, the official rate of interest is linked to the repo rate. So when Treasury notifies us that the repo rate has gone up, you can add 1% to that repo rate to arrive at what we call the SARS official rate of interest for fringe benefit purposes. And that rate as of the 1st of February 2023 is 8.25%. So practically, if you are charging your employee 5%, then the employee is getting 3.25% interest benefit as a result of their employment. Now, obviously, if they went to the bank, they wouldn't be getting a 5% interest rate. So SARS's attitude is, because of your employment relationship, if the employer is giving you a lower rate of interest than what their official rate, 8.25%, you will pay tax on that, the interest value that is the difference between the 8.25 and the 5. Now, the payroll system would be set up to put in the loan value. It would also require you to put in the 8.25% official rate of interest. And obviously, if 8.25% was being charged, there would be no interest fringe benefit. But should you choose to pay charge a lower value, the payroll will calculate that difference and tax it as a fringe benefit. That fringe benefit goes to code 3801. Now, quite an important technical differentiation. When SARS talks about loans, they talk about loans that that exceed 3,000 at any one time. So if you provide a loan to an employee that exceeds 3,000, and that might be 1,000 now, 2,000 next month, and 1,000 the next month. If in aggregate it exceeds 3,000, there's going to be a fringe benefit implication. So just bear that in mind. Also bear in mind that if your company is in the business of providing regular loans, SARS can say that this 3,000 Rand exemption or threshold doesn't apply. So how they would apply that and what they would deem on a regular basis is open to interpretation. But I would say that if you have a policy in your company's policy and procedure manual that allows for loans, then I think you're going to fall foul of the 3,000 Rand exemption, and any loan of any value is going to become a potential taxable fringe benefit. There's also no value that is placed on a loan that is given to an employee to enable them to further their studies. Obviously, the purpose of that is to encourage people to become qualified and educated and be obviously less of a burden on the state. So it's a cheap option to allow the employer to fund any education. As of 1 March 2019, another provision was put in, and this relates to loans to employees where it doesn't exceed 450,000, and this was put in to enable employers to help fund the acquisition of homes, immovable property for employees. So as long as that is not more than 450,000, there would be no fringe benefit interest implications on that. Now, the only other exception, or sorry, applicable factor here is what they call remuneration proxy. And that remuneration proxy is the employee's remuneration from the previous year. And as you can see, the threshold of 250,000 is in there. So this benefit is only aimed at your lower level earners, people earning less than 250,000. Obviously, SARS think that if you earn more than that, you're on your own in terms of funding your residential accommodation. And the other provision is the employee cannot be a connected person to the employer. So you cannot put your children in there, pay them 10,000 Rand a month, and then give them an interest-free loan to acquire property. As I said in the beginning, very, very topical issue at the moment, and an issue that I deal with on a daily basis with employers, and that is the concept of retrenchment and mutual termination. Two very, very different things from an HR and from a tax perspective. Let's deal with retrenchment first, and Section 213 of the Labour Relations Act indicates the reasons when you can retrench an employee, and they refer to economic, technological, structural, or similar needs of the employer. Now, obviously, all of those issues have been litigated to death because you have to have a valid reason to retrench someone. You can't just pay lip service to the legislation. So it's important that we look at those things quite carefully. So typically, economic reasons include the ability to make money or to retain sufficient funds to continue operations. So if your employees are not enabling you to make money or are such a burden on you that you cannot continue operations, that would be a valid reason to do a retrenchment process. So importantly, the next line, they refer to these reasons may not be confined to the current financial situation, but be included in projected financial circumstances. So with the economy being hard, the company could do projections that show that their sales are going to plummet and their overheads are going to increase and that it is not feasible to have such a high salary bill and that retrenchment might be required. So I still believe you're always on thin ice, and that projection is only a projection, it's not fact. And if your projections don't hold water and are not based on reasonable assumptions, you could be dragged to the CCMA. The courts are divided on whether the desire to increase profits is a fair reason for retrenchment. I can also understand that, but at the same time, people go into business to make profits, and shareholders are demanding people, and they want their dividends and their return on their investment. So, yeah, I think you would have to be quite careful, when you're doing that process. The second reason, technological reasons, the introduction of a new chemical formula, equipment, computer packages, systems, techniques, those might all require the reduction of labor. Now, obviously in South Africa, we live in a challenging environment where we have quite a large sector of our working population is blue collar. And with blue collar comes the union movement, and the challenge in that space could lead employers to look at new ways of doing business, and that could result in retrenchments. So technological reasons could be an extremely valid reason for undergoing a retrenchment process. And then structural reasons, the need to retrench could include the need to flatten the management structure, or to switch from a functional corporate structure to a project-based structure. Lots of companies get too top-heavy, and when new leadership comes in, they look to flatten that structure, and that could result in a retrenchment process. So in terms of what are the rules in terms of payments to employees? Let's look at notice pay first. Notice pay, if the employee was employed for less than 6 months, they get 1 week's notice pay. If the employee was worked for more than 6 months but less than a year, they get 2 weeks notice pay. If the employee is employed for more than a year, they get 4 weeks notice pay. Now, that mustn't be confused with severance pay. The employee is entitled to 1 week's remuneration for every year of completed service. Two important concepts there: remuneration and completed years of service. Remuneration does not just include basic pay, and completed years is completed periods of 12 months. Moving on to mutual terminations. Very, very topical issue at the moment. We've seen more mutual terminations recently than in previous years. And employers frequently have reason to conduct these mutual terminations to bring about the termination of employment. Very much I don't like you, you potentially don't like me, or this is just not working. We're both frustrated. Maybe a mutual termination is the way to go. So the benefits of such an agreement includes the avoiding of the need to have a protracted dismissal process. So what I mean there is to jump through the hoops that are required in terms of labor legislation, and where you agree an amount with that employee that is palatable to both parties as a final settlement to sever the employment relationship. And what this does is you sign an agreement saying that you both agree to that, and that there's going to be no litigation, there's going to be no CCMA applications. Unfortunately, we've seen that after many of these agreements have been entered into, employers are still dragged to the CCMA. Employees find that potentially that they didn't understand something, or they have some sort of a regret in terms of the value that they agreed on, and then it goes to the CCMA. So what I've said is it's paramount that the employers safeguard themselves when entering into such agreements by doing the following things. You must ensure that the implications of the agreements are clearly communicated to the employees. Clear communication is something that causes a lot of problems in companies in multiple areas, and it's important that in such a touchy area such as mutual terminations that the communication is crystal clear. Often there's a language barrier, and I always suggest that people have a translator there, and that even potentially the agreement be put in the language of the person who's being terminated so that there can be no confusion. I also suggest that a witness be present, and that all parties sign that the contents and the implications have been explained and agreed on. And very importantly, the employee must enter into the agreement voluntarily and free of any duress. So you can't threaten the person in any way, otherwise you're going to be in the CCMA. It's important to note that if the employee chooses to conclude a mutual termination, that the employee will not be entitled to UIF benefits. When are UIF benefits payable? They're payable when the employee loses their job due to no fault of their own. Now, if the employee agrees to give up their job, why would they be entitled to UIF benefits? They weren't losing their job. They've chosen to take money to effectively walk away. So, as I've said, the reason this is because the termination of employment is not as a result of dismissal or termination, retrenchment, and it's come about by agreement. We've seen, and I was dealing with one of these last week, case where the employee is quite keen on a mutual termination, but they're not keen on losing their UIF benefits because they're a long-standing employee. And they were attempting to bully the employer into calling it a retrenchment. So, as I've said to you, the retrenchment is a very different process from a mutual termination. So you can't have the benefits of each one. You can't, so to say, you can't have your cake and eat it. A mutual termination would still require the employer to get a tax directive from SARS, but the big difference between that and a retrenchment is with a retrenchment, the employee gets the 500,000 exemption in their lifetime. So let's use an example. They get a 200,000 Rand retrenchment package. They haven't used their 500,000. That 200,000 Rand would be tax-free. Unfortunately, with the mutual termination, when we apply for that tax directive, we're required to put in the employee's annual remuneration. And then the tax that is calculated on the mutual termination amount is quite simple. SARS merely go to the tax tables and say, where does the person's annual remuneration fall in terms of tax brackets? And then what is the marginal tax rate in that bracket? So if it's 26 or 31 or 36 or 39 or 41 or 45, SARS will tax them at that rate. And then obviously that goes into the payroll, and when they submit the tax return, any over or under taxation comes out in the wash. So just to summarize quickly, mutual termination might be a nice thing if you want to get rid of an employee and they're happy to go. Just remember, the employee doesn't get UIF, so that's they don't get the year's benefits, and they don't get the tax exemption. Moving on to bursaries, I've just put in a little table that you can have a look at, and it just covers the bursary thresholds. The top line, if you give a bursary to an employee you've got no problem. If you're providing bursaries to relatives of employees, you can see you've got your 600,000 threshold. So only the employees you in 600,000 or below would qualify, and then the next 4 lines you'll see the bursaries at the various levels for disabled or non-disabled relatives of employees, and you'll see there, depending on the grades and the NQF levels at university or Technicon, you'll see the thresholds of 30, 90, 20, and 60,000. This slide I've just included to show the various RP5 codes, because they're all not the same. And as you can see, if the employee is earning foreign income because of being out of the country for more than 183 days, you'll see those codes as well. Just a reminder, this is something that also was on SARS radar for quite a few years before it was changed. You cannot enter into a salary sacrifice arrangement with an employee to give them this bursary tax-free. What was happening was there were quite a lot of companies out there that were formed, and they were harassing companies into signing up with them to have a salary restructuring process. And what they were doing is they were effectively just saying to the clients, if the person's earning 200,000, we can give them the 60,000 Rand exempt, so they will save the tax on 60,000. Now, there was multiple challenges there. The first thing was SARS would attack that scheme on the basis that there was an entitlement to 60,000 in the beginning and not 140,000. So I was never satisfied or happy that those schemes were applicable. SARS would, in those days, have preferred that the bursary be factored into future earnings. But now what SARS have said is, if this word salary sacrifice, if there's any sacrifice of salary to accommodate this bursary, then you've got a problem. And then it's not going to be a legitimate exemption, and SARS are going to tax it. Okay, let me just move on. Leaderships. Also, multifaceted arrangements that are also often misunderstood. Only the lead employer can lead into a learnership agreement with the learner. And what the process requires is, this lead employer is normally the person, or is the person who's paying the remuneration. So particularly if you've got a group structure, this person might be doing work for numerous companies in the group, but the remuneration would be paid by one company. They would be the lead employer, and they would qualify for any benefits as a result of learnerships. Employers receive an additional tax deduction over and above the salary expense for entering into what we call formal learnership contracts. You can't just pull someone into your company and say, well, this person's now on a learnership. It has to be a formal learnership in terms of one of the seaters. It has to be registered. SARS are going to look at that. And the tax benefits that they give are income tax benefits. They give an annual allowance, which is paid every year, obviously prorated if you enter into a learnership during the year. And then there's a completion allowance. So there's a rand amount that is allowable as a deduction in the year that the employee completes the learnership. So just to explain that, when we talk about an allowance, when the company's doing their annual tax return, they're going to have a set of financials, which they're going to capture into the tax return. Further down the tax return, the employer is going to actually put in deductions. for numerous things. It might be wear and tear, but in this case, it's the annual and the completion allowance for learnerships. So they would have to put in the rand amounts onto their tax return to reduce their taxable income. It's not tax that you're getting as a deduction, it's actually an allowance. The value of the allowances differ based on the NQF level of the learner, as it did in the bursary case. And the value of the allowance increases if the learner has a disability, as the same sort of logic as the bursaries. Remuneration paid to learners is subject to normal PAYE legislation and the requirements of the national minimum wage. Learners are subject to UIF, and learners must be on your COID earnings report. Last thing you want is the learner to be injured or die or get sick on duty and they not be covered. Now, what I've done here is I've just put in a slide to show you the learnership allowances. And as I said, you've got your annual allowance and you've got your completion allowance and you've got your learners with disabilities and those with no disability. And you can see the rand amounts that are applicable to the various NQF levels. A learnership allows for a recognized national qualification to be obtained. Very importantly, and of value to employers, is the fact that when you bring on your learners, they can qualify for ETR claims. We hear that in the budget there's going to be some sort of expansion of the ETR program, and when I do my budget webinar, I will cover those issues. And then learnerships qualify for BE points. Not my area of expertise, so I will not expand on that. Internships. The reason I've included internships is because people confuse learnership and internships. An internship is a watered down version of a learnership from a rand benefit perspective, but it's just as valuable. And they're useful programs to address skills shortages, allowing qualified people to be exposed to practical experience, on-the-job training. There's no specific time frame to an internship, and it would depend very much on the value the person is to the entity and their needs of the entity at that point. Interns would normally be paid a stipend of some sort to cover their expenses. One of the advantages for the intern is they get put in the shop window, they get the experience to add to their potential NQF qualification, and it makes them more employable. And obviously, if you do a good job as an intern, there's a good chance that you're going to be employed. The challenge comes in, obviously, if the stipend is above the tax threshold. I generally would suggest that if you are paying a stipend and it is above the SARS threshold, that you actually put it through the payroll and you pay tax on it. Moving on to home offices. I was asked to include home offices because we've got quite a few clients who are formalizing the home office concept. With COVID, everyone was at home having a home office, and what's happened is quite a few people aren't going back to their offices because their employers have found out that it's not required and they can maintain productivity whilst working from home. So I've included the tax implications of the home office. Okay, so important that if you are working from home, that you're productive, that you're still client-facing, you're not just lazing around, and that you're delivering the levels of productivity for your employer. But unfortunately, not everyone's disciplined, and we've seen numerous challenges from an HR perspective. Employers having challenges in terms of the expectations, behavioral issues, discipline, and the standards of their employees whilst at home. I think it's clear that, you know, if you are not disciplined and you are not aware of the expectations, I don't know how you wouldn't be, you could have challenges. You know, we've seen employers saying, you know, we can't have employees in their pajamas on Teams meetings, looking scruffy, having children screaming, dogs barking. So all those issues are important, and it's important for the employer to set that standard in writing and manage that very carefully. Obviously, to the employee, it's nice because you're not doing the commutes. Your time is a little bit more flexible. I found your days are a little bit longer, obviously because you are not on the road and you are available. And for the employer, it means that expansion may not be necessary, and there's cost savings in terms of office space. Now, from a tax perspective, there's no specific tax section that talks about home offices. So any deduction that you might have in terms of a home office on your tax return would be in terms of Section 11A, which is your general deduction formula. And I've included a bullet point there explaining Section 11A in terms of what a qualifying expense is. More importantly, though, is Section 23B, which in terms of legislation prohibits the deduction of private or domestic expenses. Now your challenge is you're working from home, you're incurring expenses at home. Those are domestic or private expenses, so technically are not deductible. Obviously, there's exceptions because you're working partly for trade and partly for private purposes, and that's where your home study expenses come in. Now, the word partly is important because you can't claim all the expenses because not all the expenses are business related. So you would have to do some sort of apportionment. And there's a very set process in terms of that apportionment, which I'll explain later. So importantly, the employer must allow the employee to work from home, and SARS requires that to be put in writing. So if you are going to go the home office deduction route, you must have a very, very clear letter on a company letterhead or in your letter of appointments, clearly saying that you are required to work from home and that you don't have an office provided by your employer. And then more technically, the employee must spend more than half of their working hours working from their home office. More than half gravitates to the word mainly. The word mainly is used a lot in legislation, as in company cell phone use or company laptop use. It must be used mainly for business purposes to qualify. And you must work at home for mainly or more than 50% of the tax year. You must have an area at home used exclusively for this purpose. Now that's probably the area where most people fall foul. I've done a tax return this year where SARS required us to take pictures of all four sides of the room, and they didn't want to see how great your decoration was. What they wanted to see was that room used exclusively for business purposes. So having a treadmill or exercise bike or sewing machine or weights in the corner would shoot you in the foot if you were looking to claim home office expenses. The room has to be used exclusively for business purposes. It must be specifically equipped for the trade. So you would have to have a desk, you'd have to have your laptop, printer, storage facility. You can't be sitting in the lounge, you can't be sitting in the dining room to qualify. Types of expenses that can be claimed. So you can have two types of expenses, those that are common to the residents, and then you've got those that are specific to the study. So the types of expenses that are common would be the interest on your bond or your rent paid, repairs and maintenance to the house, lights and water, maid, household insurance, rates, security. So all of those would have to be apportioned. And then you've got specific expenses. Obviously, the equipment in your office would be subject to wear and tear or repairs. You could claim those in full. SARS do not allow the following expenses to be claimed as a deduction: cell phone and home phone, general repairs or stationery. So if you were incurring cell phone expenses or stationery expenses, you would have to have some sort of a reimbursement from your employer or some sort of a taxable allowance to get that money back. You can't claim it as a deduction. Okay, so now you want to make a claim. So I've listed the 3 steps here. The first step is to calculate the total square meterage of the home, and then the total square meterage of the office, and to work out a percentage. So if your home is 100 square meters and your office is 10, then obviously your home office is a 10th of your home. You need to apply this percentage in step 2 to the total home expenditure. Remember, you have to, that's the apportionment that I spoke to. You can't claim the whole expense, you can only claim a 10th, because only a 10th of the common expenses apply to the home office. And then we would add expenses specific to the home office. That is the depreciation, repairs of that office. That's all. Unfortunately, there are capital gains tax implications, and what I've done is I've just listed an example here, taking into account there's a 2 million rand exemption on the sale of a primary residence. So what this example does is it shows the sale of a property, but it also shows you the number of years that you've claimed and you've utilized the home office and the percentage of the home office. And what it does is it shows you the tax that is going to be applicable to capital gains tax should you use a home office. Now, I'm not going to go through the example. You can look at it yourself. The point to take out of this slide is if you're going to be using a home office for 20 years, the tax deduction that you get from SARS far outweighs the capital gains implications. It's just important that you, going into this, don't forget that there is an implication. I'm not so sure SARS would pick it up. I'm not so sure that their systems are linked, that when you sell your home, they go, whoops, reminder, this person's had a home office deduction for 20 years. We must get our capital gains tax, or there must be a reduction in the exemption. I doubt that's going to happen. But if you don't do it, you potentially always going to be vulnerable to a knock on the door from SARS. So what are the challenges? This is very, very important. And if you decide to go the home office route, please note that these are the bullet points that SARS are going to try and catch you out on. SARS are rejecting up to 80% of the home office claims because people are not applying the rules. The offices don't meet the requirements of a home office. As I said to you, you're sitting you literally put your laptop on the dining room table and you work from there. It's not a qualifying space. It's not used exclusively for business purposes. You send that photo into SARS and your wife's sewing machine or treadmill is in the corner. It's not exclusively used for business purposes. Not adequately equipped. So you've got a couple of couches and you're just sitting there with the laptop on your lap, SARS are not going to go for that. It's not mainly used. So in other words, you only periodically use that office. So you might use it 1 day out of 5. You're going to battle to convince SARS that you mainly use it when working. You do an incorrect apportionment. So you apportion the whole property's square meters, or you under apportion. SARS are going to do a correction. You claim the bond cost instead of the interest on the bond. That's a very common mistake. People think it's a wonderful thing. I can claim my bond. No, you can't. You can only claim the interest on your bond. So you'd have to get a bond interest certificate for the year to claim. And if you, in the beginning of your bond repayment cycle, you'll see that the interest is quite high. So that's great. Tax refunds get tied up. With the one I did, we had 3 different reviews, and it took about 4 months. So I do ask the question, is it worth the effort and the stress? 20,000 Rand tax deduction, with you potentially saving 8,000, is it worth your time and effort to jump through all those hoops with SARS, and particularly the frustration of dealing with SARS? Okay, then the last section we're going to look at for today is employee transfers. So we got 3 broad exemptions in terms of the legislation. The transportation costs of the family members' possessions, an employee, obviously. Property sale costs, and then the temporary rental accommodation, which is limited to 6 months at the employee's new place of work. So the employee would qualify for exemptions in all 3 of those categories. Now, on this slide, I've just included the qualifying expenses that the employee can claim. Flight tickets, personal belonging removal costs, bond registration, cancellation, transfer duty costs, agents, school uniforms, curtains, minor refurbishments, vehicle registration fees, connection costs. All of those are claimable. Non-qualifying expenses, though, are architect's fees. So you can't go and spend a fortune on an architect on your new house and get your employer to pay it. And then obviously if you lose on the sale of your previous residence, you can't hold that against your employer. At the bottom of the slide, I've listed the 2 IP5 codes that must be used. The qualifying expenses will be stored against IP5 code 3714 and non-qualifying expenses against code 3713. 3713 is your other taxable code. Now, as of 1 March 2016, the practice of allowing 1 month's tax-free salary in lieu of settling in costs was stopped. That was quite a nice process because you could just give 1 month's basic salary to the employee and then they could fend for themselves. That was stopped. Employees now have to prove actual costs incurred. So my suggestion to employers is to have a company policy and a company process in terms of how this happens. You quite clearly list what you're willing to cover. Otherwise, the employee is definitely going to take a chance with you. And then put in place the paperwork. What schedule has to be filled in, what documentation has to be supplied, and who has to sign for it before it gets into payroll. Care must be taken when transferring employees on probation. Contracts must be very specific in terms of who covers costs should the relationship not work. Don't leave that loose end because it could come back to bite you and prove to be expensive. There will be fringe benefit implications if the repayments of transfer costs are written off. It's important to save all the paperwork relating to the reimbursement, as there's a high probability of it being audited. And as I say, if you've got a process and a policy and you keep all the documentation, it's all signed off, SARS auditor comes and sees that, immediately gets a good impression of your organization and is less likely to continue digging. Okay, so that is that for now. What I would suggest, if you've got any questions, please address them to me via email. I'm more than happy to answer them. My email address is Dave, D-A-V-E, at HRTORQUE.co.za. And if I can help, I certainly will. We've got a couple of webinars coming up. We've got a budget webinar that I will do in the first week of March. And then we are going to be doing, probably in the third week of March, a legislation update. So we're going to look at all the legislation that has been updated since last year and all the new proposals in the budgets as well, in a little bit more depth, probably a webinar of an hour, hour and a half as well. So that will be advertised a little bit closer to the time. Thank you for attending. I hope I added some value. And yeah, if you want to look at any of our previous webinars, they are on YouTube and they're also on our website. Thank you so much. Have a lovely day.